My name is Indira Rajaraman. I was born in Delhi and attended educational institutions in Delhi before going on to get a PhD from Cornell University in the US. I taught for 18 years at the Indian Institute of Management in Bangalore from 1976 to 1994. And then we moved back to Delhi, where I held the Reserve Bank of India chair at the National Institute of Public Finance and Policy until my retirement at the age of 60. After retirement, immediately after retirement, I was a member of the 13th Finance Commission, which took 2 years. And after that, I served a 4-year term on the Central Board of the Reserve Bank of India. I'm going to speak today on the fiscal structuring of the Indian Republic, which has held us together as a federation. Not enough is known about the fiscal structure laid down in our Constitution, which, as it turns out, was very far-reaching in terms of looking ahead and seeing what it was that would hold the country together. Ours is a diverse country. We owe it to the Constitution, and I'm going to tell you about what the Constitution has done, which has enabled us to hang together as a country. I'm going to speak to you today about the survival of India as a federally structured republic. At the time of political independence in 1947, India had to integrate 500 plus independently ruled principalities and hold together as a single country. Everyone predicted that this just couldn't happen, but it did. We have survived. And what I'm going to speak about today is the manner in which the fiscal relationships, by fiscal I mean taxes and expenditures, which obtained between the union government at the center in Delhi and the state governments all over the country, that relationship has been critical in holding the republic together so far. These principalities, which I was referring to, were pieced together into larger units called states, and these were then federated into a union of states. At the outset, we were a two-tier federation, the union government, and at the second tier, the states. And each of these tiers had their own taxation rights and expenditure responsibilities spelled out in Schedule 7 of the Constitution. Today, we have 28 states after the conversion of Jammu and Kashmir out of statehood, and 9 union territories because Jammu and Kashmir, the erstwhile state, was split into 2 union territories. By union territories, we mean they are directly administered by the government at the center. A third tier was added to the Indian Federation by constitutional amendment starting in 1993. And the functions they can execute are listed in Schedules 11 and 12 of the Constitution. However, the third tier is different from the top 2 because it cannot make its own laws. It does not have its own legislature. So it is subjected to legislation enacted at the state level. Today, we have urban local governments numbering roughly about 4,000 all over the country. And we have rural local governments numbering 260,000. So very large numbers of local governments subordinated to state legislation in the states in whose jurisdictions they lie. I spoke earlier of the fiscal structure of India as having been key in holding the country together. And 3 features have particularly enabled this hanging together of the country. First, borrowing rights of states and the limits to those rights are spelled out in Article 293 of the Constitution. In just a moment, I will go into details about those. Let me go on to the second key feature, which is that fiscal assistance from the center to states is written into the Constitution as a statutory obligation, as prescribed by independent bodies named finance commissions. These bodies are set up every 5 years to prescribe for a prescribed 5-year horizon, and they have a finite life of 2 years. The third very key feature is that government accounts of both center and states are audited by an All India Audit and Account Service on a uniform template. Let me go on now to borrowing rights under Article 293, which I mentioned as the first key feature which has held the Indian Federation together. Clause 1 of Article 293 permits state borrowing only within India, not directly from external sources. This has been a very key provision, keeping out financial meddling by foreign powers at the subnational level. It is indeed possible for multilateral agencies like the World Bank or the Asian Development Bank to lend with a particular state in mind, but the counterparty with whom they sign the contract is not the state, but the central government, and the central government then on-lends to the state. Clause 3 of Article 293 is even more important. It requires that all state borrowing within the country should have the prior consent of the Government of India. There are some conditions under which this prior consent must be obtained, but those conditions continue to hold up to the present day. Why is this so important? It is important because we can see from the example of other federally structured countries like Brazil that if states can borrow indiscriminately without getting any approval from the central government, rogue states could drag down the rest of the country with them, because when a state in a federation borrows, the lending institutions or individuals assume that there is an implicit guarantee of a bailout from the central government. In fact, Brazil has followed the example of India and after 2005 has instituted controls on state borrowing by the federal government in Brazil. But how is the total entitlement to borrow divided between states? Prior to 2005, aggregate permissible state borrowing was defined, but the share of any individual state within that aggregate was determined through a negotiation process that was not transparent. After 2005, the 12th Finance Commission incentivized states to enact fiscal legislation, setting their borrowing programs so as to converge to 3% of their state domestic product, and this has been endorsed by successive finance commissions. The Reserve Bank of India is the issuer of public debt of all governments at the central and state levels, and that has been the case all along. Now let me go on from borrowing to the second key provision, which I mentioned as very important in having held the country together. Statutory fiscal assistance from centre to states as prescribed by finance commissions. The dominant component of this annual statutory flow, which we have had for the last 70 years and more, as a permanent feature of the fiscal structure of this country, is that the dominant component is a prescribed share of central taxes, which is automatically deducted from the tax collections at the centre and goes to states. This is an unconditional flow. By that I mean that states don't have to justify anything to receive this, it automatically flows to them. And the centre is not looking over their shoulder to see what they are spending it on. Arguably, this is the key feature of the fiscal structuring of India which has held us together. Even when there are bitter political differences between the centre and particular states, nothing can disrupt this statutory fiscal assistance, which is constitutionally guaranteed. In addition to this tax share, there are grants which are much smaller, and these grants can carry conditionalities. Let us look at the two pie charts that are up there before us. The pie chart to the left is the share of the tax share and grants in the total statutory flow going from the centre to states, which held over the period 2010 to 2015, as prescribed by the 13th Finance Commission, of which I was a member. The second pie chart gives us the composition of the statutory flow over the period 2015 to 20, as prescribed by the 14th Finance Commission. We are now at the tail end of that period. March 31st, 2020 marks the end of the 14th Finance Commission prescription period. You can see that the tax share in both pie charts is completely dominant. This is the blue component. It was at 82% during the horizon of the 13th Finance Commission, and the 14th Finance Commission raised that further to 88%. The small beige slice of the pie is grants going to states, and you can see that that has reduced somewhat, going from 2010-15 to 2015-20. And the gray slice is the grants going to local bodies, which has grown somewhat. But you can see that the tax share is dominant, and that is the unconditional component that I was referring to earlier. Going on to the 15th Finance Commission, which has just submitted its interim report for the year 2020-21, you can see that the tax share has been brought down slightly from 88% to 81%. Grants to states have risen a little to 10%, and local grants have also risen to 9%. But overall, you can see that there has been a remarkable stability across finance commissions in that the unconditional tax share accounts for 80% or more of the total statutory grant flowing from center to states. I mentioned that the last pie chart was from the interim report of the 15th Finance Commission for the year 2020-21. It's not usual for a finance commission to have an interim report pertaining to just 1 year. The reason it happened this time was that the conversion of Jammu and Kashmir from being a state to being split into 2 union territories meant that there were many adjustments that had to be made to accommodate that change of status. And so the 15th Finance Commission was given a further year in which to complete their final report, which will now go from the period 2021 to 2026. And what we have is an interim report now for the year 2020 to 21. Moving on to the next chart, which shows you the percent to total state revenues of flows from the center. You can see that it's very important that we should look at how important those statutory flows are from the state point of view. What we spoke about earlier was what flows from the center, from the source. But at the destination, if what is received is not important, then it might not have held the country together. But you can see that in the last 5 years, each tower in this chart is for a separate year, the last 5 years. You can see that the statutory flow provides to states in aggregate 30% of their total state revenue. The little beige top-up on each of these towers is the non-statutory flow. So over and above the Finance Commission prescriptions, there are flows going from the center to states which are more discretionary in character. They don't have any statutory backing. The center is not obliged to assist states in this way, but it does do so. Adding the two, you can see that total flows from the center account or have accounted in the last 5 years for a little under 50% of their total state revenue. You can see, therefore, that the fiscal relationship between center and states is a very close one. The center's flows are very important to states to keep them afloat fiscally, and this is the glue that has held us together. I'm now going to go on to the relative power of center and states in terms of their revenue-raising capability. What you have in the chart in front of you is a thick black line which goes from 1950-51 to 2017-18, the last year for which we have firm data. You can see that this black line has fluctuated a lot. But if you take an average across the years, going from 1950-51 to 1990-91, you can see that the center's share in gross tax revenue over those 40 years averaged out at 66.9%. What that means is that for every rupee of tax collected in this country, 67 paise was collected at the center and the rest by the states. After 1991, starting from 91-92, you can see that that black line has suffered a drop with, of course, year-to-year variations. And when you take the average, which is given by the red dotted line after that year, you can see that the centre's share in gross tax revenues has dropped to 62.7%. So there has been a 4.2% drop in the share of the centre in gross tax collections in the country. Why did that happen? That happened because 1991 was, if you remember, a major watershed year in which reforms were introduced in the country, opening up the country to external trade in a very big way. Imports were allowed in freely with reduced tariffs, and exports gained from that openness and also rose very exponentially. We also know that the rate of growth of the Indian economy ramped up significantly after 1991. But what 1991 did was that it reduced the collections of the central government from tariffs on imports. And that is why the centre's share of gross tax revenues fell after 1991. So what has happened after 1991? States are collecting a larger share of gross tax revenue. And at the same time, they're also getting a higher share of central tax revenue as prescribed by finance commissions. At the start of reform, finance commissions were prescribing roughly 24% of the centre's tax revenue to go to states. Today, finance commissions have prescribed that flow at 42%. So you can see that there has been a very substantial jump in terms of statutory flows from the centre to states. And this has continued into the year 2020-21 by the 15th Finance Commission interim report. So what does this mean? States are collecting more of their own revenue, and at the same time, they're also getting a higher share of central tax revenue. Why did this happen? Or to put it differently, why did the centre allow the states to rise in fiscal importance? This, in turn, was because starting in 1992, the United Nations, particularly the United Nations Development Programme, UNDP, started issuing something called the Human Development Report. This has been issued annually ever since then, and it highlighted the poor performance of India in functions falling in the domain of states, as prescribed in Schedule 7 of the Constitution. The Human Development Reports construct for every country in the world something called a Human Development Index, HDI, and India got a poor score on that human development indicator. Poor nutrition, high infant mortality, high maternal mortality, poor sanitation, poor levels of primary education. These are all functions assigned under Schedule 7 of the Constitution to states. That was the reason why there was a rise in the fiscal importance of states in terms of what they naturally collected and what was given to them from the centre. Let me go on then to current issues which are there before us, some of them solved, some of them contentious and in the process of getting solved or addressed. If a larger share of revenue is accruing to states so as to improve human development outcomes, the distribution of the tax share between states also has to achieve what is called horizontal equity, so that the more prosperous states like Haryana and Maharashtra get less than the poorer states like Bihar and Orissa. At the end of the day, we want uniformity in what is, after all, one country, in the access that people have to public goods like law and order, justice, roads, control of air and water pollution, preventive health, and primary education. Ideally, there would be a target level of per capita provision of such goods and services, and the statutory fiscal assistance would top up the gap left after own revenue collection by states. But there is a problem. The problem is that taxes actually collected cannot be the basis for a top-up because the tax effort varies across states. There are some states that are very good at making their tax effort approximate the maximum that they could collect given their situation, and some states are very poor in their tax effort. So a correction has to be made by assuming mean tax effort. That is, we have to assume that all states are collecting taxes at the mean tax to GDP ratio across states and filling in the gap only beyond that presumed revenue collection. There was a conflict between equity and incentives, even in respect of population, which might at first blush seem to be a neutral factor in distribution of the statutory share between states. We are always coming up against this conflict between equity and incentives. In the case of own tax collections, you remember we had to make sure that we assumed mean tax effort, because if you didn't do that and if you just went by what states collected on their own, you would be rewarding poor tax effort. But it turns out that there was a problem with population too. What happened was that states told the center that if the distribution of the statutory share between states were to go by the most recent population census at any time, states which hadn't made an effort at population control would be rewarded. They would get a perverse reward, and there would be a perverse punishment for states which had strived very hard to reduce the fertility rate of women and to reduce their rate of population growth. So over a span of 35 years, 7 finance commissions were explicitly directed in their terms of reference to freeze population shares of states at the 1971 census, to prevent population size from becoming a perverse incentive for states to neglect population control. As you know, population size is still a very big issue with us today. The 15th Finance Commission is the first which has been directed to use state population shares from the 2011 census to determine state shares. This was objected to by southern states which have achieved marked success in population control. There was a meeting convened by the southern states at which they strenuously objected to this change away from the 1971 census. They sent a letter to the President of India protesting this and thought this was absolutely intolerable, that they should be punished for having controlled their population so effectively. What we have before us here is a table showing the various factors and the weights that they have been given in distribution of the tax share. First and foremost, of course, is population. It's a very, very important factor which determines the relative share of states. As I have just said, it was held at the 1971 census, which was very unfair in a sense, because the additional population which came into being after the 1971 census in the heavily populated states, it was true, they came into existence because of poor effort at population control, but they are there and they are citizens of India and they cannot be neglected. So I was in favor of the switch to the 2011 census because the southern states have reaped the advantage of doing population control for 35 years. You can see that in the rightmost column, which shows the share of population, I've written 15 plus 12.5. So 15% is the weight that is given to population as measured by the 2011 census, and 12.5 is the weight that has been given to the reduction in the fertility rate in the states. This was added on as a way by which to mollify states which had indeed achieved great success in reducing the fertility rate of women. You have area, which in the forthcoming year has a share of 15% in the total weight. Area is a very important consideration also, because in a sparsely settled state like Rajasthan, in order to reach public goods across the landmass of the state, you do have to take account of their cost disability in having to take these public goods across larger distances. Economic inequality is a dominant factor in the whole formula. It has a weight of 45%, and it is entirely right that it should be so, because ours is a country with a regrettably very wide variation in prosperity levels across the country. Forest cover is a factor which has newly come in. It now will carry a weight of 10%. And the reason this has been brought in is because states like Arunachal Pradesh, which are covered with forest and with dense forest in particular, yielding external benefits not merely to us, the country surrounding in which they are embedded, but to countries immediately surrounding them on the other side of the border, and indeed to the whole world. These forests give external benefits to the whole world. So it was important that a state like Arunachal Pradesh should be compensated for the fact that so much of its area is under forest cover and cannot be put to quote-unquote productive use. And there are some other factors which I will not go into, which have been given a weight of 2.5%. And in all, of course, the weights sum to 100. I mentioned earlier that the tax share is unconditional and has been a very, very important reason underpinning the fact that the Indian Federation has been together in a harmonious way. But you also saw those small slivers which go as grants. And the reason statutory grants came into play was because there was a need felt for encouraging states to do particular actions towards outcomes in which they were not performing very well. The 15th Finance Commission for 2021-26 has promised to address the following underperforming sectors. In terms of sectoral support for nutrition, we have a large population of undernourished children and undernourished mothers. Sectoral support for health, pre-primary education, for the judiciary. We know how clogged our courts are and how access to justice is all but impossible, especially for poor people. Rural connectivity, railways, statistics. We know that data on the Indian economy have been challenged in recent years. And finally, police training and housing. The stress on this is because at the end of the day, it is the police who have to protect property and person in India. You know that we have many crimes in this country, particularly gender-based crimes. And unless the police are given gender sensitivity training, they cannot be expected to perform in an environment like that. They are also going to have performance-based incentives for agricultural reforms, what are called aspirational districts, which are districts characterized by widespread poverty, poor nutrition, and very poor connectivity, power sector reforms, incentives for education, enhancing trade, including exports and promotion of tourism. So tall order to have grants which will address all this. Perhaps that grant sliver will grow a little bit and will eat into the tax share, but it cannot eat into the tax share by very much because of the great importance of having an unconditional transfer. One sector was particularly singled out for urgent attention in 2020-21 in the interim report of the 15th Finance Commission. And that was, they provided a nutrition grant. That was the only grant that they specifically provided for in terms of sectoral focus. Why did they do that? India's rank in the Global Hunger Index has fallen from rank 93 in 2015 to rank 102 in 2019 out of 117 qualifying countries. This is a terrible situation. Therefore, the 15th Finance Commission felt that a nutrition grant could not be delayed until they brought out their final report, and they specified a nutrition grant to supplement pre-existing programs, which amounted to a provision of roughly 900 rupees per beneficiary for a total number of beneficiaries of 8.6 crore or 86 million. These beneficiaries are summed across infants, young children, and expectant and lactating mothers. Unfortunately, this recommendation was not accepted by the central government for the forthcoming budget year, on the grounds that such funding has to be integrated with the Integrated Child Development Scheme. The ICDS has not been a highly performing scheme of the central government, but nevertheless, the central government felt that that program needed to be examined and perhaps restructured, and that an additional nutrition grant would not serve any purpose. Moving on to disaster funding. With climate change-induced fluctuations in weather patterns, funding for disasters has to be one of the major statutory grant components provided for by finance commissions. A disaster grant has been in place all through, but the importance of the disaster fund has grown over the years because the number of disasters we've had every year, ranging from cyclones to earthquakes to flooding, has increased over the years. The 15th Finance Commission has made a major change in the configuration of these grants to have components for both disaster relief, which is what we have had all these years, and disaster mitigation. This focus on disaster mitigation is new and it's very welcome because we know that there are several things we are doing as I speak which are hastening the onset of disasters. Going forward, there will also be a need to destroy man-made structures that have been instrumental in blocking natural drainage channels and causing urban flooding during the monsoons. In conclusion, Finance Commission flows only compensate for underlying inequality in tax capacity, flowing from underlying differences in per capita income, but they do not address the fundamental reasons for that inequality. These can only be addressed through correcting basic structural deficits in the poorer states, in physical infrastructure like all-weather roads, rail transport, and poor law and order, leading to insecurity of property and person. You saw that I spoke previously of some grant components providing for police training and also for better data and so on, but physical infrastructure is not provided for by Finance Commission grants. Those come in through the non-statutory grants, the top-up that I showed you in those towers some slides ago. The present ratio of per capita income between the richest and poorest states, if we were to confine ourselves to the large states, is 5.5 to 1. But if we were to look at all states and include also the smaller states like Goa, the ratio of per capita income between the richest and poorest states is 11.3 to 1. Our country remains one of the most unequal in regional terms, and this is something that we need to correct and hopefully will correct going forward. As I mentioned, starting in 1993, when the Constitution was amended to include a third tier of government, local bodies, we are a three-tier federation, and rights to collect taxes are vested at each level of those three tiers. The central government collects taxes as specified in the Union list of Schedule 7. State governments collect taxes as specified in the state list of Schedule 7. And local governments collect taxes whose powers have been vested in them by their respective state governments. That is as far as the constitutional provision goes. But what typically are the taxes that we pay, and to which level of government do they accrue? When you pay an income tax, or when a corporate entity pays an income tax, that accrues to the center. When you pay duty on an import, that also accrues to the center. What do states collect? Earlier, they used to collect sales taxes on sales of goods within their jurisdictions. But after the Constitution was amended in 2015 to permit the center and states to jointly levy something called a goods and services tax, the GST, for the first time, the tax domains of center and states were merged. So today, when you pay GST at, let's say, 18% on some purchase, 9% of that goes to the state where you have made the purchase, and 9% goes to the central government. However, that 9% which goes to the central government gets merged into the total tax revenues of the center, and 42% of that will still flow to the states, all states in aggregate. So it is not as though what states collect from the GST is confined to the state GST portion, which, as I said, is half of the total rate collected. They also get their share of the 42%, which is collected by the center. However, that 42% is distributed between states according to the formula of the Finance Commission. So they won't get that 42% back by jurisdiction. It's not as though they will get back 42% of what was collected in their state. They will get their share as determined by the sharing formula of the Finance Commission of 42% of the central collection. And let me add one more qualification. It was 42% when Jammu and Kashmir was a state. Now that Jammu and Kashmir is no longer a state, the share of states has been reduced to 41%, and we have to wait for the final report of the 15th Finance Commission to see where they will position that sharing percentage, because every Finance Commission has the right to change that sharing percentage. Municipalities and Gram Panchayats have a tax base, a tax lever, which is assigned to them in all states, and that is the property tax. The property tax that you pay on your residential house, the property tax paid by commercial entities, these accrue to municipalities and to panchayats. The problem, however, is that panchayats in particular don't have much of a property tax base at all. For instance, thatched roof structures cannot be taxed under the property tax. So panchayats, rather more than municipalities, are dependent on their respective states for a grant to tide them over. It was because of that starting in the 1990s, finance commissions have prescribed a local grant. If you remember the gray sliver in those pie charts, which has grown to what is going to be 9% in the forthcoming budget year, that local grant was prescribed precisely in order to aid local governments, both urban and rural, since their tax base is limited. In the case of some municipalities like in Mumbai, the property tax base is quite large, but it is very small in smaller cities and of course essentially non-existent in rural areas. So you have therefore a local grant which does not go directly to local governments because under the constitution the center cannot send any funds directly to local governments. So it goes through the states. It is sent to the states for onward transmission to local bodies. The allocation of funding from state governments to local governments is not in accordance with what people would like. And one particular service which is very underfunded all over the country today is police protection. You will have noticed that in many cities in India, there are gated communities where essentially private guards have been appointed in order to perform the function of policing, which is really a city function. It is the police which are supposed to keep the people safe. They should not have to hire private guards to protect apartment blocks, but they do. And of course, the streets are under-policed. In part, it's because even the limited police resources that exist are lopsidedly distributed towards the protection of politicians and other people deemed very important, and therefore they're not available for the protection of ordinary people. But to answer your question about the funding of these, yes, police, except in Delhi, which has a particular status whereby police is paid for directly by the central government, in all other states, police is paid for locally, heavily financed by the state government, but not sufficiently. I'm glad you asked that question because this is a very current live issue bearing on the federal structure of the country. Going back to those pie charts, if you remember, the blue portion, which was the dominant portion, is the tax share, and it's unconditional. And I mentioned that it was a very important reason why the federation has hung together. Having an unconditional tax share has been a very important thing for states because they claim, and the public finance literature also supports them, that they should not be directed from above as to what they should do with the funding which comes to them. The idea is that they will choose their expenditure patterns, and that if the population is not happy with what they have chosen, the population will vote them out. So they consider themselves to be downwardly accountable to the electorate and resent having any expenditure directions given to them from above. However, as you noticed, the tax share, although still above 80%, has been ceding space to grants. And why has it been doing that? It has been doing that because grants can be conditional. They can be sectoral. And as you saw from the list of sectors that the 15th Finance Commission has said they are going to pay attention to when they come out with their final report in October of 2020, you can see a large number of sectors were listed, starting with nutrition, but including police, training and housing, and a whole host of other sectors which they feel the states have not paid enough attention to. So your question is a very, very important one. It bears on the distribution of the statutory grant between an unconditional tax share and conditional grants. And those who see the common population of this country, you and I, not getting enough from the state, broadly defined, for the particular services that we need, that indeed is why the share of that grant sliver has grown and may grow even more. During the colonial era, you will remember that the colonial administration was handled by a very, very small sliver of officials at the top. And they were all urban residents for the most part, except for the odd district collector, one in each district. So because they were urban residents, a lot of attention was given to urban services. Post 1947, we became an electoral democracy. More than 80% of the population was resident in rural areas. There was a need to attend to the neglected rural sector of the country, which had suffered for a century or more under British rule, owing to very severe taxation of agriculture. So as a result, the attention of the democratically elected government, whether at the center or states, shifted from the urban sector to the rural sector. That's one point. The other is that the kind of goods and services that people are looking for, what are called public goods by economists, that is to say non-excludable, non-rival. What we mean by that is clean air, let's say. If we have clean air, we all benefit. If we have dirty air, as you know, we all suffer. And although rich people can buy themselves some reprieve from dirty air by buying air purifiers, this option is not available to most of the population. So pollution is something that affects everybody, and cleaning up pollution is one of the public goods that we expect government to work actively towards. But what has happened with the structure of our democracy and the structuring of our elections is that political competition between political parties has led to an increasing wooing of the electorate by providing goods which are excludable and rival. So, for instance, political parties will compete against one another by providing, let's say, gadgets of various kinds, or liquor, or a big dinner, or something which is a very excludable, rivalrous kind of good, and does not fall in the classical set of public goods which governments are supposed to provide. This is what political competition has done to the nature of government spending, the increasing focus on transfers to benefit particular segments of the population. So we need to sort this out. Increasingly, I think elections in India are rewarding governments for paying attention to public problems, public issues, and hopefully we will be moving towards more provision of public goods and less of the kind of individual transfers that we have seen in recent decades. From a fiscal perspective, we do suffer from a particular limitation, which is that the overall tax to GDP ratio aggregating across the center and states is currently running at around 17.5% of GDP. Out of that 17.5%, 11% is tax revenue collected by the central government, and 6.5% is collected by states, adds up to 17.5. This is one of the lowest tax GDP ratios in the world. Even our neighboring countries like Sri Lanka and Bangladesh are more successful at collecting tax revenues. It's well known that there is widespread evasion in India, evasion of not merely income tax, but also what are called indirect taxes, like the GST, for instance, is an indirect tax. And it has been a huge struggle for governments to enforce payment of taxes. So you might well ask, why does India have this particular problem? Why don't those other countries have the same problem? The reason is that we still have not solved a very key problem in any democracy, which is funding of political parties. So what happens is that a potential taxpayer is a person who has the option of contributing to the funding of a political party, and to that extent gets some reprieve from having to pay taxes into the formal exchequer. So political party funding has become a competitor to the exchequer. And that is why we have had such a problem with tax evasion in this country. But as recent elections have shown, and we need to take courage and strength from that and encouragement, we know, for instance, that in the recent election in Delhi, many of the candidates of the winning party found their funds through crowd-sourced platforms. That is, they advertised on their website for an invited funding from ordinary people. And adding up the small bits and pieces, they were able to get enough to run their political campaigns. So this is the future, as I see it. Technology has enabled these crowd funding platforms, and hopefully in future, there will be less of competition between political party funding and funds going into the exchequer. We will see a rise in the tax GDP ratio, and we will correspondingly see an improvement in the services that you and I look for. There has been an estimate done by the International Monetary Fund, which was recently aired by them. It was a little too severe, I thought, in terms of estimating evasion. But I think going from 17.5, which is where we are at the moment, to 22% should be relatively easy. And that will be a phenomenal change in the funds that will be available at the center and the states. So 22% is, I think, where we need to be. 25% is perhaps achievable, but I don't think we should shoot for more than that. Well, the states which have controlled their population are very angry about this move away from the 1971 census to the most recent census, which in the case of the 15th Finance Commission will continue to be the 2011 census, since the 2021 census has still not happened. They are annoyed about it. They feel that it carries a perverse punishment for states which have controlled their population. But the issues which arise in the case of statutory flows from the center and delimitation are really quite separate and distinct. In the case of transfers from the center, what are these transfers for, after all? They are meant to provide comparable services in terms of public goods, non-excludable and non-rival, cleaner water, cleaner air, law and order. These things are supposed to be broadly uniform across a country which varies widely in prosperity levels. Unless you take account of the present population, even in states which have not tried very hard to control their population, you are not being fair at all. After all, the population, the new population which came into existence because of the failure to control population, they are there. Nobody asked them if they wanted to live. They have come into being. We have to recognize the fact that they exist. And we have to provide for them just as we provide for the more controlled population in other states which have paid attention to population control. And furthermore, states which paid attention to population control reaped the benefits of their attention over a 35-year span. They were getting an allocation in proportion to their share in population in 1971, which was much higher than what it was or is today. So they have reaped their reward. And it is now time for them to recognize that people who have come into existence, they were born for no fault of their own in states which did not pay attention to population. They nevertheless have a right to exist, and they have a right to be taken into account when transfers are calibrated according to the Finance Commission formula. That is a very different issue from the delimitation exercise, which is going to give less political power at the center to states which have controlled their population. I don't have a ready to answer to that. That is unfortunate, and perhaps a political commission should be formed to take care of the problems that could arise if some states which have been very dutiful in controlling their population find themselves punished in terms of becoming politically less powerful in a new forthcoming political configuration. The southern states, which have been leading the pack of states in terms of population control, they have also been magnets for migration. Yes. And in fact, much of the routine work in these states, including agricultural operations, harvesting, could not possibly be completed without in-migration from the northern states. Now, in the population census, there is a distinction made easily available from the figures in terms of the natural growth of population and also the growth on account of migration. But even if you add on migrants, these states have not grown very much in population. The simple reason being that the migration that does happen is seasonal. Population flows in from the northern states just for the harvesting operation, and then it goes right back. Most of these migrants do not become permanent residents. If they do become permanent residents, then yes, they do get counted in the permanent population of the state from census to census. But since much of the migration is seasonal, they don't get counted. And so yes, these are all important issues that need to be taken on board when looking at issues like delimitation. I'm happy you asked that question because, as a matter of fact, if you look at constitutional amendments over the years, the movement of functions and subjects has been from the state list to the concurrent list, which is to say that the state list has been whittled down to some degree, and these functions have moved to the concurrent list. So why did that happen? A lot of that movement took place during the emergency in the mid-1970s and was political in nature. But a lot of the movement was really not political. It happened because there was a sense of dissatisfaction in the country as a whole and at the center that functions which had been assigned to states were not being adequately addressed by the states, such as, for instance, nutrition, such as, for instance, maternal and child mortality, infant mortality. We had huge disparities between states in infant mortality. We had some states which had infant mortality at levels prevailing in Europe. We had other states whose infant mortality levels were at those prevailing in sub-Saharan Africa, worse sometimes. We could not tolerate these huge divergences within what is, after all, one country. We have to give an infant born the same chance whether that infant is born in a poorly performing state or in a well-performing state. It was for that reason that some of these functions, though not all these functions, were moved from the state to the concurrent list. And the reason that was done was in order to enable the center to pass laws in Parliament requiring certain minimal levels of achievement in the states, which they could not have done if they had been passing laws on a subject which was in a state list. So that is why many subjects were transferred to the concurrent list.